Hey, Eric here from 5minuteinvesting.com. And today we're going to talk about great business model examples and how that impact investing. So for those of you who don't know me, I have been investing for over 10 years, and my goal when I'm investing is to aim for 30% a year in the market. And one of the things you probably want to study is business models, and what are some of the great business models that are going around currently, and how you can spot a great company. Because when you see a great company, they probably have a good business model. So let's talk about what we're going to dive in today. So we're going to talk about recurring revenue streams today in terms of business model. Then we're going to look at a couple of different types of business models that I believe are fantastic, like transaction-based, subscription-based, and then we'll also cover some one-time business model which I don't think are as good as recurring. So let's talk about what is a recurring revenue stream, or what kind of business would build around a recurring revenue stream. So when you're looking at revenue streams, it is the lifeblood of business. Business rely on revenue to survive, and there's actually a famous quote from the CEO of Google, Eric. His name is Eric as well, and he said, "Revenue solves all problems." And in the world where there's a lot of innovation, in the world where there's a lot of disruption and change, a predictable revenue stream is extremely important. And if you can charge a customer month after month of the same amount, this allow you to create better financial forecasts. This allow you to build a business because there's less seasonality. And one of the things I look for when I'm investing in the market and try to get 30% is a recurring revenue streams. And this mainly comes in two forms. One is transaction-based, and another one is a subscription service. Now, a transaction-based is actually very common in the consumer world, where let's say you use your credit card, and it's MasterCard or Visa card, and every time you swipe it, you get the merchant will pay a percentage. Usually is around 0.3% to 2%, depending on the volume. But essentially, every time a transaction happens, the merchant will pay. And the same is true for PayPal. If you are using PayPal, then every time you buy goods or you sell something, the seller will be paying a transaction cost. And whenever you're exchanging currency between US dollars to Canadian dollars, or US dollars to Hong Kong dollars or whatnot, you'll be paying a spread as well, which is a transaction cost. Let me just fix the board here. So what does that mean? This means some of the good companies that you want to look into, maybe MasterCard, maybe Visa, maybe PayPal. And when you actually search these companies up online, you'll actually find that they have a very strong trend, and they grow consistently year after year. Now, why is that? Because when you're looking at these companies, what's important is how many customers, in this case vendors, they have. And as long as the customer base is increasing, and let's say each customer makes around 10-20 transactions a day, then you have a very predictable volume of transactions every month, and you are just taking a percentage of the transactions. So this becomes very profitable for these companies. And I think Elon Musk was the one that built PayPal, later on merged with, Elon Musk built X.com and later on merged with PayPal to become PayPal, and then it got bought out by eBay, because the merchants of eBay are heavily using PayPal. And now eBay IPO'd PayPal, and now it's a public company you can look into. So you want to do your research around PayPal if that's something you're interested in. For Visa and MasterCard, that is pretty obvious. In China, there's Alibaba, which owns Alipay, and WeChat, which is owned by Tencent, which has WeChat Pay. So these two are the equivalent of PayPal, MasterCard, and Visa in the China world. So in India, there's a couple of other vendors, but I'm not too familiar with that market, so I wouldn't go into it. So the next one is really, I'm going to skip ahead and talk about Square. So when you think about MasterCard and Visa, this is the old generation of payments, and it has been around for many years. And then afterwards, and then there's PayPal, which came 20 to 30 years ago, probably 20 years ago. And then now there's Square. So if you have never heard of Square, Square is a mobile payment company, and they're one of the first ones, and it started by the founder of Twitter. I guess after the founder realized that Twitter is not making much money. So he went and started a company that makes a lot of money and revolves around payment. Now, how did this company start? Square actually focuses on mobile payments, and if you looked at Square early on, they actually have a little plug-in that you can just plug into the headphone jack of your phone, and then you can swipe credit card. Now, that is an interesting value proposition because that means street markets or farmers markets, these merchants can accept credit card payments, which usually is pretty difficult with Visa and MasterCard because you need a power source and you can't accept mobile payments back then, so on and so forth. And using that first mover advantage, Square quickly got a large audience and a large vendor base in this case. And once you have a large vendor base, the company is on a great path to success. Because remember I said the way to derive recurring revenue is based on transactions, and transactions comes from a large customer base. And if the customer has 10, 20 transactions a day, then quickly that becomes a lot of transactions within a month. So if you go search up the stock Square as of right now, you'll actually see the company is doing quite well as of the moment I'm recording this video. So other than internet companies, other than payment companies, there are actually more traditional companies that are also based on transactions. For example, Walmart. When you're looking at grocery stores or supermarkets, their revenue really comes from helping you buy goods. They are a distributor, and it will be based on volume and transaction. And that's why Walmart has such a strong focus of being lean, being efficient. Because when you are in a transaction-based market, your margin is really, really thin. So you want to focus on being lean. You want to have efficient operations, so then you price out your competition. Now, Walmart was a discounted supermarket that started many years ago, and there's a book called there's a book written by Sam Walton himself about his story and how he started Walmart. If you haven't read it, I recommend you to read that book as well. Now, this market started a long time ago, and Walmart pretty much won that market. So when you think about it, if you look at the stock price for Walmart, chances are it's still going up and it's still increasing. But you want to think about, well, for Walmart, it's pretty mature. Is there any growth remaining? Can this company continue to grow so that your stock price will increase? Because at the end of the day, if you have a transaction business but the company itself is not growing, the stock price is not going to go up. Okay, another example is airline. Now, again, airline is a very transactional base. Now, there are some premium airlines in the market, but those are usually not doing that well, and there's also a high chance of bankruptcy. So airline is probably one of the more difficult industries because the oil price fluctuates a lot. So then when you invest in airline, you want to make sure that it is a good and efficient airline that can continue to grow. So airline and supermarkets, these two are actually pretty saturated markets already because they have been established quite a while ago. Now, if you rewind our time 10 years ago, then you will be thinking, well, for Walmart, what is the new Walmart? What is the next Walmart? then naturally, with a bit of hindsight now, you actually think it's Amazon. Because Amazon focuses a lot of being efficient. They sell everything online on the single store of Amazon.com, and right now they're offering one-day delivery, same-day delivery. And I think in some parts of US and UK, they actually offer 1 to 4 hours delivery. So it's crazy and how efficient they try to be. So when you think about it, this transaction-based business model is really an efficiency game, and getting the market share early on so then you get the volume of transactions. So the scale of the company becomes very important, and as the company becomes bigger and bigger, the profits of the company will also grow. Alright, so that's the first type. So you want to look out for these kind of companies, and you want to make sure that the company has demand, it can grow, and there's opportunity to expand. Now, if you're interested in the Amazon of China, it's actually Alibaba and Tencent as well. They also are into this type of businesses. They own Tmall, and there's other online shopping malls in China, like JD.com, that are also online. But in terms of information available, it will be way less than US companies. So the next type of business model that is fantastic is subscription based. Now, you usually see this with internet online related businesses like email subscribers, like email service provider like MailChimp, and there's a recent one called Slack, which kind of replaces email as kind of like a messaging app, and right now is IPO, so you can actually search Slack online, and it recently IPO as of the moment I'm recording this video. So subscription service is really beneficial to the business because you can calculate what is your monthly revenue, and instead of trying to find a new customer month after month, your goal is actually to retain customers month after month. So one of the key metrics for a subscription-based business is churn rate, which is the percentage of people quitting every month. So if your churn rate is really low, that means let's say you have 100 customers and they're paying you $10 a month, they'll continue to pay you $10 for many months to come, assuming they don't cancel the subscription. So one of the famous businesses that is not public is actually Dollar Shave, if I remember the name correctly. And they charges you a monthly fee, and they send you new shave like blades and so on, and help you manage your beard or whatnot on a monthly basis. And it was a hit, and a lot of guys signed up for it, and it made a viral video, so then they got a customer base. Later on, there are a lot of subscription services that are similar to Dollar Shave, and I think Dollar Shave was sold to another company for quite a bit of money. So subscription services are usually pretty popular, and they are also pretty profitable. Now again, it's all going to come back to demand, growth, and expansion. So if you have a subscription service that is not growing and the market is saturated, then even if you have a good business model, the stock price is not going to go up. So for example, magazines. Magazines is usually a subscription service, and before magazine figure out online, they actually try to sell you physical magazines and they ship it to you. And over time, people forget about it, which is fantastic. But what's more important, it's actually people are not reading magazines anymore, and the industry now is declining. So for certain magazines, they actually switched to online, and for some magazines that didn't switch, they stopped existing anymore. And another example would be comic books. And back in the day, when Marvel was releasing comic books, they actually still release comic books. It was a thriving business because people would read it chapter after chapter, so it's kind of like a subscription service. However, people stopped reading comic books, and the industry itself is in a decline. So later on, they switched to movies, which is the whole Avengers series, and they have 22 movies just to finish the first arc, and that created a subscription type service for movies using comic books. and now that totally revamped Marvel itself, and later on it got sold to Disney. But before they figured that out, the comic book industry was actually saturated, and Marvel almost went bankrupt. And that's why they need to sell their best characters like Spider-Man, like X-Men to Sony and Fox, because they almost went bankrupt with just comic books alone. So you want to keep in mind when you're looking at companies to invest in the market, whether their business model is dying or whether the market is saturated. Because at the end of the day, if you have a good business model but it's mature, is saturated, there's no growth, the stock price wouldn't go up and you wouldn't be able to make 30%. Now finally, I'll talk about my least favorite business model. And now there are some great companies that are one-time revenue business models, but then I'm not a big fan of them. And I'll explain why. So what is one-time revenue streams in terms of business models? Now these can be selling cars. Now how often you buy a car? Now you might say, well, we buy a car every 10 years. Well, for some people, they buy a car every 2 years, but usually people buy a car every 5, 6, 7 years. So you don't have that recurring revenue streams. Now some of the creative things the car manufacturer tries to do is to subscribe you to a maintenance plan, or you have to come back to their auto shop to repair the car, and they try to build a car in such a way that other mechanics can't repair it. So that does create some sort of recurring revenue streams, but there's a lot of car mechanics out there, and eventually people will learn how to fix a car without going to the designated auto shop. So because of that, I actually don't think automobile is a great industry to invest in. Now, I actually do look at Tesla because Tesla is one of my favorite companies, and I have been watching it for months, and I still haven't been able to invest in the company because of many reasons. One of them is actually the business model itself, because once you sell a Tesla car, then how do you make money? And I think that is the key barrier for me personally to invest in the company itself. Now, the next one is luxurious clothing. I actually know a group of investors that absolutely love investing in premium brands like Louis Vuitton or Canada Goose. So these luxurious brands. Now, in my opinion, when the recession hits, people are not going to care so much about the luxurious brands. Now, luxurious brands are great when the market is going up, but then when the market is going down, nobody's going to buy it. So you're going to have a huge swing in revenue between the good times and the bad times. And to me, that is quite unpredictable. And also, it relies on people paying a premium for it continuously. So that's why I don't invest in luxurious clothing as well. Now, for biomedical companies that don't generate revenue yet, I avoid those as well. Now, some people will try to game on the fact that the biomedical is going through FDA trials, and the more FDA trials it goes through, then the higher the expected revenue is, because the moment it launches a drug, it's going to make a ton of money. Now, this requires a lot of specialized knowledge. It requires you following the development of the drug a lot. And if you look at FDA approvals, it's actually quite a difficult process, because you got to first have the concept, you got to test it on non-human subjects, then you got to test it on humans, and you got to run multiple trials until it gets approved, and the whole process can take years. And when the biomedical company is doing this, it's not generating revenue and is paying for many biomedical scientists to do research and development. So the concept of biomedical companies is actually very risky in itself. And if I'm going to put my life saving into it, I want something that is stable, I want something that is predictable, and something that I'm pretty sure I can get 30% from. So the last one is really consulting. Now consulting is really broad, and there are really two types of consulting. And in this case, I'm really referring to the one-time revenue consulting versus recurring revenue consulting. So one-time revenue consulting will be doing a big project, doing a big transformational project that once you finish, then you're done. Now recurring revenue consulting projects is quite different, and they are good because you provide continuous service to the clients, and this will allow you to have a stable income stream, and this also allow you to function more like a subscription service instead of a one-time revenue. Right now I can't think of too many one-time consulting services company off the top of my head other than IBM. So IBM used to be a computer company, and later on they sold their computer division and they moved into consulting, and they have IBM Watson and all that. But in my opinion, IBM focuses on transformational IT projects, but then it's not necessarily recurring. So this creates a flaw in the business model, which makes the business model itself riskier. And when I'm investing in the market, I focus on companies that are transactional based or subscription based, so then I'm sure there's a recurring revenue stream. So that's pretty much my view on business model and how I get 30% from investing in the market by selecting good business models. So let me know if you have any questions. You can leave a comment below. You can share the video if you like it, and I'll see you in the next one.